Bitcoin's real problem. For more than a decade, Bitcoin has been wrapped in powerful narratives. Digital gold. Store of value. Inflation hedge. The future of money. These ideas have been repeated so often that many investors now treat them as facts rather than claims. But markets do not operate on repetition. They operate on behavior. And when behavior changes, narratives get exposed. Right now, Bitcoin is facing something more serious than a price correction or a bear market. It is facing a role problem. Not a technology problem. Not a survival problem. A classification problem. And that distinction matters far more than most people realize. Because assets don't fail when prices fall. They fail when expectations collapse. This video is not about whether Bitcoin will recover. It is not about whether Bitcoin will still exist in 10 years. It is about something much more uncomfortable. What Bitcoin is actually doing, versus what people expect it to do. That gap is Bitcoin's real problem. What a store of value is supposed to be. To understand why this matters, we need to be precise. A store of value is not defined by ideology. It is not defined by white papers. And it is not defined by scarcity alone. A store of value is defined by function. Its job is simple: preserve purchasing power over time, especially when uncertainty increases. Not outperform stocks. Not deliver excitement. Not generate spectacular upside. Preserve value. Historically, assets that serve this role share a few characteristics. They are relatively stable. They are trusted across cycles. They do not require constant monitoring. And they tend to perform differently from risk assets when stress appears. Gold is the classic example. Gold is not exciting. Gold is not innovative. Gold does not double in a year. But when confidence erodes, gold tends to hold its ground. That predictability is the entire point. Cash functions similarly within limits. Certain government bonds do as well. They are boring. And boring is a feature, not a flaw. Bitcoin, by contrast, is anything but boring. Bitcoin's volatility is not a side issue. One of the most common defenses of Bitcoin is that volatility is temporary, a side effect of youth, adoption, or market structure. But volatility is not a cosmetic issue for a store of value. It is a foundational one. An asset that can lose 50% or more of its value in a short period is not preserving purchasing power. It is demanding belief. And belief is not the same as trust. Volatility may be acceptable in growth assets. It may even be desirable for speculative trades. But for value preservation, volatility is corrosive. Bitcoin's defenders often say, just zoom out, but zooming out does not erase drawdowns. It does not erase time underwater. And it does not erase the psychological cost of holding through prolonged weakness. Those costs are real. A store of value should reduce anxiety, not require emotional endurance. The inflation test was the moment of truth. Bitcoin's strongest claim over the past several years was inflation protection. The logic seemed straightforward. Fiat currencies expand. Bitcoin supply is fixed. Therefore, Bitcoin should protect purchasing power. This argument became so widely accepted that many investors stopped questioning it. Then inflation arrived, not theoretical inflation, but real inflation. Prices rose sharply. Interest rates surged. Liquidity tightened. This was the moment Bitcoin was supposed to prove its purpose. And instead, Bitcoin declined significantly. This is not opinion. It is observable market behavior. During this period, Commodities rose, energy surged, certain real assets repriced, inflation-linked instruments did what they were designed to do, Bitcoin did not. Supporters argue that Bitcoin is still early, that adoption is incomplete, that the market misunderstood it. Those arguments may contain some truth, but they do not change the outcome. An inflation hedge is not judged in calm conditions. It is judged during inflation. And by that standard, Bitcoin failed the test. That does not mean Bitcoin is worthless. It means the narrative was overstated. Correlation reveals more than price. If there is one factor that exposes Bitcoin's real problem more clearly than anything else, it is correlation. Bitcoin has repeatedly behaved like a risk asset. When equities fall, Bitcoin tends to fall. When liquidity tightens, Bitcoin weakens. When interest rates rise, Bitcoin struggles. This is not incidental. Correlation is measurable. And it has persisted across multiple market environments. A true store of value should diversify risk. Bitcoin has often amplified it. This is not a philosophical debate. It is a portfolio construction problem. If an asset declines at the same time as stocks, it does not hedge a portfolio, it compounds drawdowns. Markets understand this. That is why, when stress rises, capital often leaves Bitcoin rather than flowing into it. The market is telling us something very clearly. Bitcoin is still treated as part of the risk complex. Time underwater is the hidden cost. Bitcoin supporters frequently point out that Bitcoin eventually recovers. That is true. But recovery alone does not define a store of value. The critical question is how long capital remains impaired while waiting for that recovery. Extended drawdowns matter. They test patience. They test conviction. They test whether an asset is appropriate for capital that is meant to be preserved rather than grown. Bitcoin has spent long periods well below prior highs. Not days. Not weeks. Years. That kind of time underwater imposes real costs, financial and psychological. Stores of value are not supposed to demand that kind of endurance. They are supposed to provide stability. The psychological burden of Bitcoin in this aspect is rarely discussed, but it is crucial. Assets do not exist in a vacuum. They are held by people. And people have limits. Bitcoin requires constant attention. Extreme volatility invites constant checking. Large drawdowns create stress and doubt. This is not how most people use stores of value. Gold holders do not check prices hourly. Cash holders do not worry about sudden collapses. Bitcoin demands emotional resilience. That alone should signal that it does not yet function as a mature store of value. Bitcoin's real problem is misclassification. Here is the core issue. Bitcoin is not failing because it is useless. Bitcoin is not failing because it is obsolete. Bitcoin is not failing because the technology is broken. Bitcoin's real problem is that it has been misclassified. Bitcoin can be many things at once. A technological breakthrough, a decentralized network, a long-term asymmetric bet, a speculative asset without being a reliable store of value today. Calling it one prematurely created unrealistic expectations. And when expectations collide with reality, credibility suffers. The market is now correcting that mismatch. Early is not an excuse. One of the most common responses to criticism is that Bitcoin is early. That may be true in historical terms. But early does not mean exempt. Early assets are not entitled to roles they have not earned. Gold did not become a store of value because it was scarce. It became one because it behaved consistently across centuries of crises. Bitcoin has existed primarily during an era of cheap money and rising risk appetite. That environment masked weaknesses. Now conditions have changed. And Bitcoin is being tested in a harsher reality. Design intent does not equal outcome. Another mistake many investors make is assuming that design intent determines function. Bitcoin was designed to be scarce. That does not automatically make it stable. Bitcoin was designed to be decentralized. That does not automatically make it defensive. Markets assign roles based on behavior, not intentions. Right now, the market treats Bitcoin as liquidity-sensitive, volatile, speculative, not as a safe harbor. That classification may change, but it has not yet. What would actually change the narrative? If Bitcoin is to function convincingly as a store of value, several things would need to happen. Volatility would need to decline meaningfully. Correlation with risk assets would need to weaken. Bitcoin would need to hold value during stress more consistently. And this behavior would need to persist across cycles. Not permanently, but reliably. Until then, skepticism is not hostility. It is rational assessment. Why this conversation matters. This debate matters because mislabeling assets leads to poor decisions. Investors allocate capital differently to stores of value than they do to speculative assets. They size positions differently. They depend on them differently. They manage risk differently. When expectations are wrong, risk management fails. Bitcoin does not need exaggerated claims to succeed. In fact, those claims may be doing more harm than good. A more honest framing of Bitcoin, a more accurate description of Bitcoin today would be this. Bitcoin is a high volatility, liquidity sensitive asset with long-term monetary ambitions and uncertain defensive properties. That description may not sound exciting, but it is honest. And honesty builds trust far more effectively than slogans. Final thought: Bitcoin's real problem is not price. It is not regulation. It is not technology. It is expectation. Bitcoin is being judged against a role it has not yet earned. That does not mean it never will. But markets do not reward aspiration. They reward evidence. Right now, Bitcoin is being priced for what it is, not what it might become. That is not failure. That is market discipline. This is not financial advice. It is an assessment of behavior, incentives, and cycles. If you value analysis over narratives, subscribe. And let me know your view. Is Bitcoin already a store of value, or is that title still something it has to earn?